Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I am joined out there in the chat by my good friend Cameron May. Welcome to all of you, and we appreciate all of you being here. Now, you guys have the opportunity to chat with Cameron out there in the chat. Bring your chat messages, ask questions. Cameron's a 20-plus year veteran of the financial markets, and he's going to be there to help answer your questions. And we're talking index options today. We started this new webcast series last Wednesday morning with a good introduction to index options, what they are, what they do, how they work. We're going to extend that today. We're going to talk a little bit more about some of the specific strategies that we're going to use. We're going to look at some of the examples that we put together last week. We're going to put together some new examples. So for all of you that are here in the live version, whether you're here in the recorded version, stick with us. We're jumping off into index options today. A couple of quick housekeeping items as we get started here this morning. As we talk about these options and we talk about indexes, remember that everything that we talk about is simply for illustrative and educational purposes only, not a recommendation or any kind of an advice or endorsement of any particular security pattern, strategy, or anything else. Remember that equity and index options carry a high level of risk. They're not suitable for all investors. Make sure that you are aware of the characteristics and risks of standardized options before considering any option strategy. Now, multiple leg option strategies will involve multiple transaction costs, and spread trades must be done in a margin account. Now, we're going to use a lot of technical analysis in this discussion. Technical analysis is only one way to evaluate the market. It is theoretical, as is fundamental analysis, as is probability analysis. So Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Now, we're going to be using the thinkorswim desktop software platform. That's what you're going to be seeing on the screen. We're specifically going to be using the paper money version. Now, remember that the paper money version of the thinkorswim platform does not do certain things. It doesn't allow us to use studies in scans, but we're not going to do a lot of scanning here anyway, because we have a fairly small group of indexes that we're going to focus on. But it doesn't allow for, or doesn't facilitate the early assignment of short options. But we're going to talk about that when we talk about index options, because that might not be such a big issue when we talk about it in this context. Because remember, American style options, short options, can be assigned at any time up to expiration, whether they're in the money, at the money, out of the money. European style options, which primarily index options are, don't allow for exercise and assignment until expiration. So that's a difference. So we're going to talk about some of those specific differences as we get into this discussion. Again, remember that investing involves risk, including the loss of principal. If we put stop orders on, we're going to talk about those stop orders specifically, but just in general, remember that stop orders don't guarantee an execution price, just an activation price. In the event of a stop limit order, there is the potential that the price could gap around the stop and the order would not fill. Now, remember that hedging and protective strategies, some of the strategies that we're going to talk about, involve potentially additional costs. They don't assure profit. They don't guarantee against loss. So make sure that you understand that. Let's get into this discussion here and kind of get a sense of where we're headed. We're going to talk about, as I said, the brief review of index options. We'll talk about the strategies that we're going to employ, and we'll look at those examples in the thinkorswim platform. So let's talk a little bit about the strategies just before we jump out into the platform itself. We're going to talk about vertical spreads, both long and short vertical spreads. We're going to talk about iron condors to take advantage of neutral movement, especially in the fact that index options, being European style, carry with them that lack of, if you want to think about it that way, lack of short option assignment or early assignment risk. That changes the strategy of short positions, specifically short vertical, short iron condors, a little bit. Same thing with butterflies, calendar spreads. We're also going to talk a little bit about hedging. Now, the other thing to think about is that one of the strategies that we can use index options for is directional speculation. both on a longer term as well as on a shorter term basis. And we are going to talk a little bit about shorter term, in fact, even sub-daily types of strategies here, including 0 days till expiration option strategies. But we're going to be doing it in a risk-defined manner. We're going to be doing it with the characteristics of index options in mind. In fact, I've got an example that I want to show you today based on what's going on. So what I want to do now is I want to shift over to the Thinkorswim desktop software platform. And by the way, as I move over here to the platform, good opportunity for me to remind you to click on that subscribe button down at the bottom of the page. That's going to allow you to stay connected to the Trader Talks webcast channel. But you can use staying connected. Let's take a look at the connection that the market has with economic data. We had a reasonably cool CPI print following yesterday's reasonably cool PPI print. The market is liking that information. In this particular case, perhaps good news is good news. Does that really, is that really how it plays out? I don't know. At least at the moment, however, we see that the SPX up on the day about 1.65%. So here we are on the charts tab on the Thinkorswim desktop software platform. This is a grid that I've put together of the 3 primary indexes: the SPX, the NDX, and the RUT, the Russell 2000. We're focusing here on a 1-year chart length in time, right? That's the span of the chart. 1-day candles. We will also look at shorter term price intervals when we look at these indexes as part of our discussion. But right now, I'm looking at that 50-period moving average, the SPX in this particular case, banging its head on that 50-period moving average. It's been below it for about a week or so. Now kind of coming back up into that, kind of into the apex of this symmetrical triangle after breaking out. And in fact, what I might do is redraw some of those. I'm going to just delete that one. I'm going to remove that one, and we're going to remove, whoops, let's come down here and we'll remove that one. And I'm going to remove this one simply because I think we could probably redraw this as a little bit more of a downward channel. We'll just kind of pull that in there. So from a really strongly bullish perspective, right, I've got a breakout of a symmetrical triangle on the RSI down here at the bottom, giving me an indication that maybe there's some upward momentum. We see this gap up right up into that moving average, and it's banging its head. I'm just going to activate this one, and we'll draw that out a little bit more. It's banging its head on this horizontal or diagonal resistance level. So this is a bit more bull flag on a longer scale than we've seen. So some traders may look for this type of movement here, that bounce up off of the bottom of the flag. Some traders might be looking for the break of the diagonal resistance for a much more bullish perspective. And I think in this particular case, that may be our kind of marching orders here for the day as we look at this. I'm going to just zoom in a little bit because we can see that the resistance here, that kind of confluence of resistance, the moving average, the horizontal or diagonal line here kind of coming together at the same point, maybe seeing a little bit of pulling back from that area, that upper shadow or wick on that candle, maybe giving us an idea that there's a little bit of fade there. We still have that momentum going, right? Because we've had 3 up days, relatively up days, even though this was a red candle, it was a net up day in a row here, kind of giving us some bullishness. If it can break out, then we might be looking for more bullish movement up to maybe under that 6120 level, that previous high, and seeing that kind of initial push continuing through the resistance level. But before we get strongly speculative, that may be what some traders are looking for, is that break of that significant resistance. If we take a look at the NASDAQ, we're not quite there on that horizontal or diagonal break. We broke the horizontal from this kind of descending triangle that was in place. The NASDAQ kind of making that move up through the 50-period moving average, the breakout of that kind of descending wedge, if you will, on RSI here on the NASDAQ. So a little bit of momentum, again, kicking back in. But where I think we're starting to see maybe the majority of the move here and the majority of the oomph to the upside coming, although also the majority perhaps of the falling off of some of that momentum is on this kind of skewed downward or skewed double bottom potential on the Russell 2000. Down, hit a horizontal and a diagonal support, rallied back up to this intermediate point, kind of the apex around that 2281, pulled back down to the 200 period moving average, now bounced back up and knocking on the door of that resistance, well off the 50, which is now kind of horizontal. But a big, strong kind of booming momentum move, but giving us a little bit of weakness here. So given the fact as that we're starting to see this, what I want to kind of look at now from a strategy perspective, now that we have this idea, let's talk about how we can use index options effectively, potentially, and effectively meaning effective based on their characteristics, not effectively meaning we're going to guarantee any kind of success, right? But given the fact that index options give us the benefit of trading a product that is directly reflective of what it is that we're talking about here, right? Not subject to earnings announcements, other than the collective pressure of earnings. We're going into earnings season. We saw some strong bank earnings today, but really reflective primarily of what's kind of the collective view of the market as a whole. So the other thing that I want to look at as we get into this is kind of the overall perspective of volatility in the market. So I've got a VIX grid, and this goes kind of hand in hand with our discussion of index. VIX, the volatility index itself, is a measurement of volatility in the S&P 500 options. So oftentimes those index options, like we're going to use them for, are used for hedging activities by institutional investors. When there's greater demand for that hedging activity, you typically tend to see the VIX rise or the VIX higher. What we've seen today is the VIX has gone up, is not at all an unexpected or uncharacteristic move to the downside in the VIX. So volatility's been bleeding off a little bit. Nevertheless, it is at still a relatively elevated level, although you could probably argue that it's at its average. This is a 30-period average of a 30-period average, which is the VIX, but it's already kind of at that elevated level. But the average has moved up to meet that. So still staying a little bit higher than it was maybe back in December and early January. But nevertheless, we still see a little bit of volatility there. It's been falling off. That benefits us as the seller of options. So we kind of have this confluence of things coming together. So what I want to do is I want to pop over here to our Market Watch tab, and I'm going to go to our quotes section, and I'm going to open up one of my personal watch lists that I built here, which is the index option indexes, the ones that we're going to use generally in this class. And the ones that we're primarily going to use are the SPX and its mini version, the 1/10 of the SPX, the XSP, the NASDAQ, the NDX, and its mini version, which is the XND, the Russell 2000 and its mini version, which is the MRUT, the VIX index, the broader kind of developed markets global index, the MXEA, and then the DJX, the Dow Jones index, although we will probably use that one a little bit less frequently. Same thing with the MXEA. Primarily, our focus is going to be on these first four or six in this particular case, as we see those minis in here as well. So now that we kind of have an idea, if we were to look at, again, let's go to our chart here, and we're going to go to our single grid, and I'm going to pop up the SPX, and we're just going to take a look at what's going on here at the moment. We see this kind of bounce to the upside we saw on the index grid, that RSI. But now, if we come over here to the trade tab, and we start to dig down into this, one of the things that we know about these index options, and this is a good review part, I'm going to go to the trade tab, we're going to open up these index options, and I'm going to open up the option chain. And you notice that One of the benefits of index options is a great number of expiration days or expiration cycles. In fact, I've got expiration cycles that occur nearly every weekday. In fact, every weekday. And in fact, some that occur on the same day, but that are AM settled, and some that are PM settled. Now, we've talked a little bit last week about AM settled versus PM settled index options. AM settled index options stop trading the afternoon or the evening market close prior to the settlement date. This settles on the morning print, the morning after they stop trading, which means that there is overnight risk. There is overnight risk. That overnight risk is the possibility that the futures could move, the market could move in that overnight time frame. So by and large, when we look at positions and we look at potential examples, we're going to focus primarily on non-AM settled option expiration, simply to avoid that overnight risk. Okay. We're going to focus on these that are shorter term. Now, here's the great thing. When we talk about demand, right? Demand for index options, demand for options in general is increasing. We know also that demand for products like or trade ideas like 0 days till expiration options is growing significantly as well. One of the challenges in any of those strategies is liquidity. And the other challenge is the possibility of early assignment, because generally, if we are short an equity option, the closer we are to expiration, the closer we are to being in the money, the greater the likelihood of being assigned early if we are short that option. Index options don't have that challenge because these are by and large European style. And so as we come down here in this particular case on the SPX to the 15 Jan expiration, these are options that will be gone and expired today. And so the thing to think about is that there is greater demand now for trading options in a single day time frame than there has been before. Now, we're talking about trading an option in the final day to go until its expiration. This is a short-term time frame. Every option that you have, whether it's an equity option or otherwise, becomes a 0 DTE option on its final day of trading. It becomes a 0 DTE option. So it's not like these are anything magical. It's not like these are anything unusual or new. Every option has been and will be at 0 DTE, 0 days till expiration, on its final day of trading. So that's kind of where we are with this perspective. Now, Jerry asks an interesting question. Why would anybody trade an AM settled option? And you might trade that if you are an index or excuse me, if you are, say, for instance, an institutional investor that is maybe looking to take advantage of potential overnight movement. But by and large, as retail traders, we're going to stay focused on those PM settled index options. Now, there's also, speaking of settled, there's a feedback survey out there in the chat. Do me a favor, help us out, fill out that survey. If you want, you can click on the survey link and set it aside and then come back to it and fill it out later, or you can click on it afterwards. Just make sure you click on it before we close the meeting down so that you get to it. All right, Cameron's going to put that up at the top of the chat. So let's look at an example. Let's jump right into this idea of how we might take advantage of this upward move. So I'm going to go back to the chart here, and we've got a pretty good move to the upside. And my expectation might be bullish, but we're banging our head, remember, on that resistance level, that diagonal resistance level that we saw earlier. So I'm bullish, but I'm cautiously bullish in this particular idea. So what's a strategy that potentially we could use that would take advantage of bullish directionality, but cautious bullish directionality, one that doesn't necessarily require a lot of movement? And that might very well be a long vertical spread or even a short vertical spread where we benefit from the passage of time. So we're going to go down here to the trade tab once again. We're going to pop in here. I know that I've got a little bit of a support level right around that 59.04 mark. I'm going to just draw that line in here horizontally. There's 59.04. That's right about there. And I know that I've got a little bit of a support level perhaps down here on the edge of that gap, 58.35, somewhere in that range. So I'm going to look at taking advantage of this directional movements that the stock has already made, or that the index has already made, and we're going to put together a quick couple of vertical spreads. So I'm going to go to the trade tab, and we're going to pop in here, and we're going to do this on a shorter term basis. We're going to do this now down about 7 days to go until expiration. So looking out to next Wednesday for this option expiration. We'll see how this trade goes. So I'm going to pop in here to the 22 Jan, and we're going to take a look at the liquidity. So what I want to do is I want to kind of come to the at the money strikes here, and I want to look at the width of the bid-ask spread. Now, this is probably one of the most highly traded products, the SPX and its options, out there in the market. And I can see that my spread on an index that's $5,900 is about 20 cents. And so that's a fairly narrow bid-ask spread here at those levels. So what I'm going to do is I'm just going to put together a long, first of all, a long vertical spread. We'll compare and contrast that to to a short put spread. So in this particular case, I want to look for one that doesn't necessarily require a lot of movement. So I'm going to go to that 59.35. The index is trading at 59.30, so we really only need about 5 points of move to the upside. And if I come over here to the right-hand side and I take a look at the current level of implied volatility, which is relatively low, and the potential move, the theoretical potential move between now and 7 days from now at about 93 points, I really only need 5 points of movement in this index to keep this at the or in the money perspective. So the goal of a long vertical spread, if you remember, and I'll show you where you can find more ideas about this, but the goal of a long vertical spread, is to be at or in the money at expiration or close to expiration. So we're going to look at selling in this particular case, the 59.35. That defines our level of risk, right? That defines the initial part of the trade. But then we're going to buy one that's a little bit in the money in this particular case, the 59.30. So we're looking for movement, but not a lot of movement. So I'm going to sell the 59.35, and we're going to sell that 59.35 for 42.60. Okay. And if I were to just leave it at that point, now we've got a bearish expectation, but we're not. We're going to go over here and we're going to buy this one, the 59.30 at the same time. So I'm using my control key to build this trade. I built it one leg at a time. So now I'm looking at a $5 wide strike, and I'm paying, well, in this particular case, just about $2.85, a little bit beyond the width of the strike, the midpoint of the spread in this particular case. And you can see that it's kind of bouncing back and forth. But what that means is my maximum theoretical gain in this trade is, as it kind of locked that down, $1.85 or $185. $1.85 times 100 contract or 100 shares in the contract, or 100 units in the contract. And my maximum loss is the width of the spread minus what I'm paying for it, right? So in this particular case, maximum loss a little bit greater than maximum profit, but this is a highly probable or more highly probable trade, because look, if we come back down here and we take a look at our delta on this trade, our delta on our short leg, the 59.35, is about 53-cent delta. And we're moving that way. In fact, we just moved into the money in this particular case. So, Motion, the reason I'm picking these particular strikes is because I don't want to have a lot of movement. I want this to kind of be within the range of kind of the reach of this particular trade. So we were looking at kind of the one strike out of the money, one strike in the money. Now, we don't have to go 5 points wide. We can go 10 points wide. In this particular case, we can adjust that. So let me pop this back up, and we'll adjust this, and we can say, hey, I'm going to go to the 59.25 and make that 10 points wide. I'm going to pay a little bit more for it, but I've got also now a greater potential maximum gain in the trade because I've widened it out. And I've brought that a little to the long side to a little bit higher delta. So a little bit higher probability of success on that long leg in the trade. So we're going to widen this out by 1 strike. We're going to put this in here, and we're going to go ahead and send this off. Now, our goal is for the price of this index to end up, in this case, above 59.35, and it's almost there. It's kind of been bouncing around. We've got 7 days in order for this to do this. So this is the reason why we're looking at this particular trade, this long vertical spread. We don't need much movement, and we're speculating on that directional price movement. And we're doing it in a risk-defined manner and cutting our costs down over just buying a long option. So I'm going to click on send, and we'll fire that order off. And that has filled for us. We bought it for $6, which means that we've got about $4 of potential gain in this trade. And what we're looking for is for that to end up in the money at expiration. So in this particular case, the reason I'm choosing those particular strikes, again, is the directional expectation. Now, I'm expecting that the price of the index is going to go up. Now, the other side of this coin, and we said we were going to contrast this, would be to use a short vertical spread that has also a bullish perspective, but maybe gives it a little bit more room. So maybe we come down here around this 58.39 level, kind of that support level that we've drawn across here, 58.39. We go back to our trade tab, and we'll stay in the same expiration time, right? We'll stay in this same expiration, 7 days to go, shorter term time frame. Now, we can be longer if we want it, but in this particular case, as we look at this trade, we're going to say, look, fine. I'm gonna look at selling. We said on the chart, let's cross check that again, right around this 58.30 range. So I'm going to go back to my trade tab. We'll go to 58.30. In fact, I've got to go down quite a bit. I've got to add some more strikes to this. Let's go 50. There we go, 58.30. Now, width of the bid-ask spread is about 20 cents. That's about 18-cent delta. So lower probability of being hit. In this particular case, the thing that we don't want to have happen is the price to be in the money at expiration. We don't want the index to go down. Again, 92 points of potential movement. We're kind of right on the edge of that. In terms of that 92 points. So we're going to go to the 58.30. We're going to sell the 58.30. And in this case, we're going to create this as a short put vertical. So I'm going to go 10 points wide, and we're going to sell or buy then the 58.20. So now I'm creating a 10-point wide vertical spread. And notice what's going on. And this will go back to the question that Beauty just asked, which is risk to reward on this trade. Look at the risk to reward on this trade. I'm bringing in $1.30. Which is all I can bring in on this trade. But my maximum theoretical loss in this case is 870. That's kind of skewed just a little bit. That may be a function of the fact that implied volatility we saw in the VIX is relatively low in this particular case. So we might go and find some additional volatility, although we're not seeing many many expirations that do have a lot more additional volatility. We could go out here to this one, which has 16% implied volatility. That's 16 days to go until expiration. Kind of go to the same thing because we know the technicals are still there, right? 58.30. Width of the bid-ask spread's about the same. It's about 20 cents to 30 cents wide. We're going to go to the 58.30. We're going to sell the 58.30, and we're going to buy the 58.20. And in this case, we're getting $2.10 for the same width of that vertical spread. We're just a little bit more extrinsic value, a little bit more volatility. So if we click on confirm and send, now we're making 205 against 795. Longer time frame to be in the trade, right? But here's kind of the thought process in creating this trade is that we might not necessarily hold this all the way to get to that 205 premium, right? We want to be able to get to this trade and buy this back for less. Now, here's the thought and the challenge, the difference between this trade using an index option versus a short vertical spread using an equity option. There's the risk of early assignment in an equity option trade. In this case, there's no risk of that early assignment. This option that short leg can't be assigned to us prior to expiration. So if we plan on closing this trade down prior to, right, we're not going to run up into that time frame where we're worried that we're going to be assigned early. So we could let it go through till expiration and either expire worthless or end up settling to cash on the expiration date. But we could also manage this trade from the perspective of saying, look, I'm going to make this a first triggers sequential. And then I'm going to do this. I'm going to create an opposite order. And the opposite order here is simply going to close this trade down. And it's going to do it in the limit order. So we don't have the risks of necessarily of a stop order in this particular case. But we're going to say, look, if we can close this down and buy it back for 20 cents or less, right, then what we've done is we've potentially capitalized on the majority of the gain and the majority of the work that this trade can do, right? So I know that we've done several classes in our webcasts on this idea of managing the trade, managing a vertical spread. I know Barb Armstrong, Cameron's done this, Brent's done this, Connie's done this, talking about managing the spread when it's done the majority of the work that it can do for us. So we're going to go ahead and we're going to fire this order off, read through the order, make sure that we're aware of it, any alerts that are there, and we're going to go ahead and fire this order off. We've got that order in place to close it down if the first one fills. So we're going to go ahead and fire that order off. And once that fills, so we sold it for $250. Now, if we can buy it back for 20 cents or less, boom, right? There you go. So we take that trade off. Now, the other thing that I wanted to do here really quickly, while we've got a little bit of time, is I wanted to go back to our charts. And I want to come over here and I want to take a look at an idea. And let's go back to our index grid for just a second. And let's take a look at what's going on the Russell 2000. So notice what's going on the Russell. I'm going to zoom in here a little more closely. So we have this rally up. It knocks its head on this resistance that it's tested once, twice, now 3 times the resistance, and it's coming off of that level. So the idea that I had here in this particular case is using an index option or an index option spread to fade this short-term rally up into this confluence of resistance level, right? So the idea being that as this index kind of comes up into this area right here, that it's going to bounce down. And even if it just bounces down to the 200, or if it bounces down in here, but we're going to take advantage of the fact that today we're seeing that rally up and it's fading. So we're going to fade this rally in the Russell 2000 using an option spread. And we're going to do it on a 0 DTE basis. So this trade's going to be done and gone by the end of the day. Okay, done and gone by the end of the day. So we're going to go back to the trade tab. Actually, I'm going to change my view to my single grid once again, just so that we can see it. We're going to pop back over here to the chart. We're going to put this on the RUT, the Russell 2000. And you can see what it's doing. Banged its head on that 2280 level, kind of right there. And it's bouncing down from that, okay? So we're going to use that as kind of our mark here, our line in the sand. We don't want the index to come up through that, but we're only going to trade this on a one-day basis. So we're going to go to the trade tab. We're going to look at this 0 DTE expiration, and that gives us a range of movement based on current applied volatility of about 13 points on the index. So if we look at where it might go to the upside, so that's about 2269 is about 13 points higher. 2269 is well down here, right? So we're off of even of that potential move. We're outside of that potential move that the index might make. Now, there's no guarantee that it's going to stay within that potential move. This is simply what implied volatility is suggesting. Now, we're going to come in here. We're after the market opens. We're after kind of that early morning volatility in the index. And we're going to look at getting out of this trade prior to the close. So this is a 0 DTE option. We're trading this in its last day to go until expiration. And we're doing it consciously, knowing the risk that there could be large movement in the index over the course of one day and no days to recover. That's why we're structuring the trade the way that we're doing it. And that's why we're structuring the trade using index options, because we don't have early assignment risk. So I'm going to go to 15 Jan expiration here. That's today. we're going to fade this using a short call vertical spread. And we're going to look at where that resistance level was that we saw at the 2280 mark. And you notice what the 2280 mark has is about a 5-cent delta, meaning this is low probability. Those deltas, especially as we get to close to the end of the day, deltas are going to move very, very quickly to a binary fashion, right? They're going to be, oh, sorry about, I didn't mean to drop my camera there. You were cutting my head off. Very, very quickly on the day of expiration, delta is going to be either 1 or it's going to be 0. And you can see what's going on here, right? We're further out of the money. So that delta is getting closer to 0, less directional sensitivity, which isn't to a certain extent what we want here. But at the same time, we want to be able to get enough to collect enough premium for this. So we might actually even come inside that range a little bit here and go to the 2275 strike. But the idea being that we're looking at taking this trade from that perspective of not being assigned early. Now, we're looking at liquidity here, and it's about 20 cents wide. I might even, just for the sake of liquidity, come down into that 2275 or maybe even the 2270 and look at fading it from that point. Because, again, we've got to strike that balance. That's going to be about the 17-cent delta. But also what I want to do is I want to change this. We know what theta is going to be, right? Theta is going to be an absolute. All this time value is going to be gone at the end of the day. Vega gets a little bit higher as we get here close to expiration, but implied volatility, unless something significant happens, isn't necessarily going to be a huge driver. So what we might do is change this to gamma, because here's what we notice. Gamma, especially as we get close to the end of the day, gamma increases. But not as much as on an equity option, because there's, again, greater, kind of a greater insulation simply because it's the index. Now, gamma is still going to become very knife point sharp on an index as we get close to expiration on the last day to go until expiration. So what that means is a small movement in the price is going to push delta very quickly to 0 or 1. It becomes almost binary at the end of the day. So we're going to trade this, and we're going to fade this this move. We're going to sell the 2270, and at the same time, I'm going to buy. We'll go 5 points wide here and see how that does for us. So we're 5 points wide, and we're bringing in 55 cents credit. Let's see if we can do better. I'm going to delete that. I'm going to sell the 2270, and we'll go 10 points wide and see if we can do a little bit better. Now we're getting 82 cents credit. So risk to reward in this case is going to be skewed, but we're not in trade for a long period of time. We expect that it's not. We're doing the Wayne Gretzky here, right? We're selling this spread where the price ain't, or where it's not likely to be, right? Okay. Now, in this particular case, so beauty, this is not at risk for assignment because this is a European style index option, which means that it cannot be assigned until expiration. So in this particular case, we don't have early assignment risk. So we're going to work this order, and we're going to look in our goal here in this particular case is to claim as much of this credit as we can. Now we've got that risk associated with it. We click on confirm and send. We're risking about 800 or 898 against $1.02 in this particular case now that we've locked that down, but highly probable. Right? From that standpoint, our delta gives us kind of that highly probable perspective. And unless something significant starts to move, but we got to be willing in this particular case, from a position sizing standpoint, to take that maximum theoretical loss, right? So from this standpoint, we could get run over by the freight train as we get down to the end of the day. So we're gonna monitor. This is not a set it and forget it type of perspective. But since I can't be with you all day long, we're going to put this trade on, and we'll review how it worked next week when we come back. So I'm going to put this trade on, knowing that we're going to look at taking either that $102 of credit in this particular case, the maximum gain that we can get in the trade, and keeping the majority of it. So what I'm going to also do is I'm going to come back and I'm going to edit this. And I'm going to create this again as a first trigger sequential, right click, create opposite order, and we're going to get out of this trade. If we can get out of this trade, if we can buy it back for, I'm going to go 10 cents or less, right? So we're going to collect, theoretically, about 80% of this maximum theoretical gain. We're going to make that good till canceled. We don't have to, because this is going to be gone at the end of the day. This expires at the end of the day. These are going to be gone. So we don't need to make it good till canceled. We can, just out of habit, and go ahead and click on confirm and send, read through this order, and we'll see if we can work this a little bit. Let's see if we can work that to a limit of a buck. Let's see if we can get a limit of a buck right there. Lock that in, close the lock, and see if we can work this order. We'll click on confirm and send, read through the order again, make sure that we're aware of any risks or alerts that are there, and make sure that we understand the characteristics of the trade. We're going to go ahead and we're going to click on send, and we'll watch that, and we'll see if that order fills. So we're going to fade, basically, we're selling this call spread above where the index is, and our expectation is that it's going to stay moving in that downward direction. We're going to kind of continue to see that collapse off of that resistance level. And we sold it for a buck. Now we've got the order in place that's going to be working to close this down for us. All right. So we're going to go over here to the monitor tab. We're going to take a look at what we currently have on the trade, right? But on trading that 0 DTE. Now, the idea being that why not put a stop loss order on this at the same time is a good question to ask, right? Why not put a stop loss? Because that volatility of, especially driven by gamma in the last day of expiration, this last time frame, could put that stop in a position where it would get triggered, and we could see that movement taking place. And so we could get filled at a significantly lower price or higher price than our expectation. So we're managing to our position size and willing to take that maximum loss, as opposed to putting a stop order, because we don't typically stop vertical spreads generally. So we're going to go over here really quickly to XSP. I've got one that's 2 days to go until expiration. It's got a little bit of a profit for me. That's a long call on XSP, working in my favor here in this particular case. So we could roll that. In this case, I'm just going to close that trade down, right click, create a closing order, and we're going to harvest a little bit of that potential gain here. Click on confirm and send, read through the order, make sure that we're aware of any risks and taking that trade off. We're going to close that one down. We closed it down for a small profit in that long XSP. But here's what we've got. We've got a long vertical spread, excuse me, a short put vertical spread on XSP. We've got a long put to protect the downside. We've got an XSP short put vertical. We've got an XSP long call vertical. In both cases, we're looking for the same thing to happen, both directionally bullish. And then we've got that Russell 2000 0 DTE option that we are expecting to move in the direction that we want it to go, which is we expect the index to continue to move to the downside. Let me pop back over here to our watch list again really quickly. I can't share the watch list with you, but I can tell you the symbols: SPX, XSP, NDX, XND, RUT, MRUT, VIX, MXEA, and DJX. Those are the indexes that we're primarily going to use in this discussion. So we've talked about, as we pop back over here really quickly, a couple of vertical spreads. We've talked a little bit about using it for hedging, and we're speculating using verticals as well as kind of fading directional price movement on the index. A couple of quick reminders when it comes to the index options. Remember that these are cash settled, which means, as Cameron put out there in the chat, there is no underlying equity, meaning if you end up short at expiration, you're going to be debited cash out of your account. If you end up long at expiration, you're going to end up having cash credited to your account. So there's the feedback survey. Fill that out, help us out, and help us to make these sessions better. If you want to learn more, one of the great places to come to is schwab.com/coaching. We've got a great forward schedule of our webcasts. And if you want to pop back over here to Trader Talk's webcast page, click on that subscribe button when you do so, and just type in here INDEX options. And you're going to see a bunch of webcasts that talk about them. You're going to see my intro to index options from last week. Lots of great stuff, guys. Thank you for being here. We're going to continue these strategy discussions. We'll see how these trades played themselves out over the course of the next week or so. I'll be back here next Wednesday. And my thanks again to Cameron May. Remember to follow us on X at Ben Watson CS, at Cameron May CS. Have a great day, everybody. We'll see you soon. Bye-bye.